Markets are on a tear today after the announcement that it looks like Trump and the team are in fact getting something going with China. So that was certainly a positive. But we have much more important things to discuss, like MicroStrategy, MSTY, and Bitcoin with our good friend and Bitcoin expert, DarkSide 2030. He's going to be joining us today on Open Interest. Hello, everybody, and welcome. Welcome to Open Mic. I'm Mike Coe. Joining me today, DarkSide 2030. If you do not follow this guy on X, and if you care about Bitcoin, you really do need to follow him. Now, this is somebody I have known for a long time. He's joined us on the live stream before. Scotty, how are you, my friend?
Doing good, Mike. How are you?
I'm good. So this is really, the timing could hardly be better because it was only a couple live streams ago that somebody was asking me about MSTY. And for those that don't know, MSTY is one of the Yieldmax ETFs. Yieldmax has a number of specialized ETFs where they look at single underlyings and then sell options premium against them. So generally speaking, they're going to be looking at things with decent implied volatilities. And they've been, getting some good yield out of these things. And if you just simply pulled up a chart, and I'm going to try to pull one up now so we can take a look at it so you can look at the price. I've actually gotten this feedback from more than one person when I have mentioned it. Let's see if I can pull this up and you guys can get a look. People have said, oh, that doesn't look that exciting. Well, they think it doesn't look exciting because they are simply looking at the price. And if you look at the price of MSTY, I think it's down something like 20% over the last 52 weeks. That doesn't seem impressive, perhaps, but that is not the story here. It's not the story by a long shot. So if you actually take a look at the total return for MSTY over the last 52 weeks, if you had taken the dividends that it pays every month, which are substantial, you'd be up 143%. If you just reinvested those dividends in treasuries, you'd be up 86%. And the reason we're so excited to have DarkSide here is because he actually spoke to Michael Venuto, who runs the one of the companies that's responsible for managing Yieldmax, and to the head trader, Scott Snyder, on his X space just 2 days ago. So Scott, tell us a little bit about these products, what's going on here, because people are really interested in these things. And you know a lot about the Bitcoin complex, including these. What's up with them?
Yeah, so it's really, really interesting that unlike kind of your traditional equities markets, Bitcoin and more specifically MicroStrategy have extremely high implied volatility. And as Michael Saylor likes to say, volatility is vitality. So very similar to Michael Saylor's strategy of monetizing the volatility of MicroStrategy to buy more Bitcoin, MSTY is monetizing the volatility of MicroStrategy to produce more fiat. So it's a derivative play on MicroStrategy. It's very interesting because you're gaining exposure to MicroStrategy, which is derivative exposure to Bitcoin, or maybe slightly leveraged exposure to Bitcoin. But you're harvesting the volatility of MicroStrategy with a high quality asset like Bitcoin. So from my perspective, I think that you're taking a lot of the downside exposure away. Of course, I'm quite bullish on Bitcoin, and you're able to harvest the volatility. And as you kind of beautifully laid out, the total returns on MSTY have sort of been off the charts from an income producing product. I don't think the market's really seen anything quite like this. But I would liken this strategy very similar to Saylor's strategy himself, right? And that's what makes it so interesting. That's what kind of caught my eye. Now, go to the next level with Mike's team, Venuto, and Scott Snyder. Scott traded on the CBOE back when I was down there. He's one of the most well-respected, highly skilled traders that I know, and he was even back then. And betting on a winning horse usually gives you winning results. So that's been sort of the MSTY story in a nutshell. Not only do they have a great strategy, a great underlying thesis, but they really have a team that they've put together that can execute.
Yeah, it's interesting because I've been seeing a lot of these types of products roll out. Obviously, options volumes have continued to grow even as equity volumes stagnated. People became more familiar with things like volatility risk premium and realized that they wanted to generate returns by having delta and by collecting some of the volatility risk premium. This is basically an effort to do that with Bitcoin essentially as the underpinning hard currency, if we want to call it like that. And actually, I wrote an article over the weekend where I was trying to remind folks that, if you go back 100 years and you earn some money, and you put your money in the bank, and you would actually earn a reasonably attractive rate of interest on your deposit. So a savings deposit 100 years ago might have paid you 4 or 5% a year in interest. And that may sound like a good rate of interest, or it may not, but I would remind people that 100 years ago, we still had a gold standard. So the FDR's gold confiscation by executive order, which basically turned us into fiat currency, didn't really get formalized until 1933. And what that meant was that you owned a hard currency asset, you owned gold, and you were earning interest on your gold. If you own stocks, so a retrospective reconstruction of the S&P 500 going back 100 years, you also would have been earning about 5% in annual dividends each year. So you had hopefully appreciating assets or growing companies, and you were receiving 5% in dividends, and those dividends were dollar denominated, convertible to gold. So again, you were buying hard growing assets, receiving hard currency. Fast forward to today, and the S&P 500 is yielding less than 1.2% in terms of dividends. And even if you got 4% interest on your savings account, that's a very different thing because you're getting 4% on dollars, and we just keep printing them. So basically, the way I described this in the article was, it's the difference between having a farm and generating income by raising crops and selling your crops, or selling off a little bit of the acreage each year. And if you have a hard currency underpinning what's going on, you are generating real income. And if you do not, you're selling off acreage bit by bit by bit as time goes on. What are your thoughts about this? And do you think that these types of products and strategies are basically proxies of a sort for trying to get income, essentially, from real savings?
Yeah, well, so let's go back to 1933 and fast forward to 1971, where we completely abandoned any linkage to the gold standard. And now where are we today? We're $37 trillion inside of a debt-based fiat Ponzi scheme, right? And ultimately, if you're wondering why all of this volatility, why this whole Bitcoin complex has grown and is burgeoning into something that the financial markets have never seen before, it's simply because the money, the US dollar, the fiat currencies of the world are unstable, right? Remember, one Bitcoin still equals one Bitcoin. So when you see the price of Bitcoin go from, $400 in 2013 to $104,000 yesterday, right? What's really happened? Well, a Bitcoin hasn't changed, but the value of the dollar has plummeted against Bitcoin. And that's the underpinning by which this, let's call it a money glitch, where Michael Saylor is able to harvest volatility. He's able to sell his currency, Microstrategy, MSTR stock or strategy. He's able to sell that currency at a 2 times net asset value, and he's able to buy Bitcoin at essentially half the price any of us can buy Bitcoin, right? So that's happening for a reason, right? Normally there'd be an arbitrage here, and that net asset value would come down to 1, right? And his strategy would be over, but that's not happening. And that's kind of led to these derivative products like MSTY that are able to, again, harvest that volatility and produce outsized income returns in fiat dollars on essentially a Bitcoin proxy. So in the end, it's because the hard money of Bitcoin is so far superior to the endless printing of fiat that you've created a money glitch. I don't know there's a better way to describe it. I know that sounds a little hokey, but ultimately it's turned into a money glitch. And as we're seeing now, you've got companies like 21, Jack Mallers, Cantor Fitzgerald, and SoftBank getting together to do the same thing. Some more scientific. I mean, it's one after the next after the next. We're seeing companies add Bitcoin onto their corporate treasury as a way to fight back against money printing. But ultimately, this is just a speculative attack on the fiat currency. Right? Well, that's all this is, right? And in the end, we know who's going to win, right? We know that there's no way they can pay off the debt. Right? Anybody who doesn't understand what a Ponzi scheme is, right? You need to create more debt to pay the interest on the existing debt. There's no way we can ever reduce our debt. The only solution to our problem is to grow our way out of it. But now that our interest expense is over $1 trillion and our interest rates are starting to tick up, not down, and our interest expense is expected to grow $200 billion this year alone. And that's refinancing the Ponzi scheme at very short-term duration. So ultimately, what's the answer to the fiat problem? I don't think there is one. We've gone through. Yeah, go ahead, Mike.
Well, I was going to say, I think you're probably on the conservative end of the refi expense estimate for this year because I think it was, well, I mean, we could look at, it depends on whether you're looking at what has already been refinanced or not, but it was 15.5 trillion that would need to be refinanced. That was the short-term debt that would need to roll between full year 2025, 26 and 2027. And the bulk of that, 9 trillion of it, was set to mature before the end of this year. And the weighted average coupon of that $9 trillion was less than 1%.
That's a problem. Huh?
So that is, well, here's a more interesting thing. The 15.5 trillion that I just referenced, the weighted average coupon for that 15.5 trillion is 1.78%, when the prevailing interest rates are 4 plus. So let's just say that something really remarkable happened and you actually were able to refi at somehow less than 4%. Let's call it, just to keep the math easy, let's just say that that's going to be 3.78% on average for the entirety of what I just described. That's 200 basis points on 15.5 trillion is over $300 billion of incremental interest expense. And that is going on while we are still running a $2 trillion deficit. So you have so work your way through that problem and you say, okay, well, wait a minute. So I'm going to have $300 billion of incremental interest expense and $6 trillion of incremental debt. The $6 trillion of incremental debt is also at about 4%, or another $240 billion of annual interest expense. So that's $540 billion of incremental interest expense that the federal government would need to be paying by the end of calendar year 2027. And that, just in case anybody's wondering, is about 10% of U.S. tax revenue.
Yeah, it's crazy. And here's the other kicker, right? Is that $2 trillion deficit, if you try to cut that, since GDP is 20% government spending, you will throw us into a recession that makes 0809 look small. So we're completely in a box. We really can't cut deficit spending, or you'll throw the economy into a tailspin, right? We really can't increase government spending because of the numbers you just laid out, right? We're fighting against the bond vigilantes that recognize that the Fed, for all intents and purposes, is out of road. So what do they do, right? That they're going to continue to sell down the long end of the curve and make it worse and worse and worse. And that's why Bitcoin is so well bid, right? Like this story is not lost on sophisticated investors. And the story certainly isn't lost on foreign investors who have begun to pull their bids out of the U.S. Treasury market. And Mike, I'll say one last thing on the subject. My friend Thomas made a really good point the other day. He said, look, the quality of the buyer of U.S. Treasuries matters, right? When we had foreign governments, when we had sovereigns, when we had foreign oil companies buying our debt, that was one thing. Now it's turning into, hey, let's loosen the SLR restrictions. Let's make it so US banks can lever up 5x, 10x. Let's make it so hedge funds can lever up 100x, coming out of the Caymans and buy US treasuries. Well, that all sounds great, but you're just making an already fragile system that much more fragile because as rates go up, now we're talking about massive unrealized losses across the entire banking system. So again, to your point, I really do believe we're pretty close to the end of the road. And that's why Bitcoin is so well bid. Look, it's a neutral asset, right? It's not tied to any government. No government controls it. And it's an off ramp from a debt-based Ponzi scheme that's about to break.
Yeah, so I want to just sort of, I'm going to delve a little bit into the ability of banks essentially to take on, essentially to be the effective buyer of all of the debt that the U.S. is issuing, and how government and government-affiliated agencies are contending with this issue. So you'll notice that, if we compare the performance, and I'll do this right now, of J.P. Morgan versus Bank of America. So we're going to just compare two money center banks. Both of these money center banks have substantial treasury holdings. It's essentially the bank's reserves are typically held in this fashion. And I'm going to reverse these two things and normalize them, and we're going to go back a few years. We're going to go back to before the rate hiking cycle. Okay. Now, what you're looking at, this bottom chart right here, this one right here, this is the relative performance of J.P. Morgan to Bank of America. Now, why did J.P. Morgan outperform Bank of America so materially? And the answer goes to what Scott was just talking about, which is that Bank of America, and I'm really wondering who inside that organization, because this is the second time basically that they've been taken over the coals, they had just a lot of duration. So duration is basically their held to maturity book. So that is all of the U.S. federal debt that they purchased, put on the balance sheet, and serves as the company's reserves. Now, the thing is, a lot of people would say, well, it doesn't matter. And it doesn't matter because they can use that as collateral and go to the Fed window. So they can take that debt and say, okay, I have all of this debt. And yes, I realize that a 15, a 20-year U.S. Treasury bond is down huge. By the way, 20-plus year bonds were down 50% from the top to the bottom. So you could have $1 trillion on your balance sheet that's really $500 billion. But you give it to the Fed and they'll loan you the money. Well, that's fine, except that when they purchased these things, the coupon was, call it 2% or less in many cases. And now you can borrow at the Fed window, but who wants to do that? Because you're going to be borrowing at the Fed window at whatever the prevailing rate is. So that's a negative carry trade. So they have liquidity in an emergency, but it's not a profitable business because you get into a negative carry trade. That's the reason we've seen this huge divergence between JP Morgan and Bank of America. So you mentioned at the beginning of all of this that MSTY is essentially the retail market participants' way of doing the Michael Saylor trade at Microstrategy. And for anybody who's watching who isn't familiar with how Michael Saylor is a volatility seller, maybe you could explain that to everybody.
Sure. So
I'll pull up the securities.
So Michael Saylor, and his financial engineers, group of geniuses, figured out that if they began to acquire Bitcoin and they changed the direction of the company, I think it was 2021, from a legacy software business that was failing to a Bitcoin treasury company, they got a multiple on their stock. Also, their stock began to take on the volatility curve of Bitcoin itself, right? So the more Bitcoin they began to buy, the more they began to actually have a higher volatility than Bitcoin. They were able to then sell securities, sell their own common stock. I mean, something as simple as sell your common stock at the money at a 2x multiple and buy Bitcoin with it, right? And from as the investor side, you're essentially buying Bitcoin at half its trading price, right? So they're creating what he calls Bitcoin per share, right? A metric. That graduated into, hey, what if we sell convertible debt and we buy Bitcoin with it, right? Which is even more accretive. And he went ahead and sold convertible debt. Then he found out, wow, if I sell convertible debt and I buy Bitcoin, I'm actually able to borrow with a zero coupon for free for the convert right. Because again, the convert is like a warrant. The warrant trades off the implied volatility. The implied volatility is so high that people are willing to lend him billions of dollars at zero cost. He then graduated to offering perpetual preferreds. He has one called Strike, which pays an 8% dividend and is convertible at $1,000 per share. Right. So then he offered Strife, STRF. That's a perpetual preferred that pays a straight 10% dividend. But because the compounded annual growth rate of Bitcoin has been averaging, I don't know, 40, 50% for 10 years, right? He's happy to borrow money at 10% for fully accretive Bitcoin purchases. So it's just been one progression after the next. So Saylor now has multiple tools in his shed. He now owns, I believe, over 550,000 Bitcoin. And that doesn't even discuss, well, hey, wait a minute. If you own 550,000 Bitcoin, and Bitcoin is the most pristine collateral the world's ever seen, the hardest money that's ever existed, what's the value of that stack? Right? I always like to say, well, wait a minute. If Michael Saylor had to replace 550,000 Bitcoin today, how much would it cost him to buy it? What's the replacement cost on 550,000 Bitcoin? Right. So when we talk about his multiple to holdings,
Off the charts is the answer, by the way, if anybody's wondering.
that's right. Right. It could, so when we talk about the multiple, let's also talk about another concept, which is bit bonds. Right. And a bit bond, without going too deep, is the concept that I would use. I would incorporate Bitcoin into a bond offering. So let's say I wanted to borrow, in Michael Saylor's case, $100 billion. And he pledges $10 billion worth of Bitcoin for 10 years, a 10-year loan. And after the 10 years, you're going to get back 50% of the Bitcoin. He's going to keep 50% of the Bitcoin. So the bondholder is going to have participation in 50% of the upside of the Bitcoin. And he's going to pay an interest rate, maybe a 1 or 2% rate, and then take that money and go into the Warren Buffett strategy of I'm going to get into the reinsurance business. So if he's able to borrow money again, including this Bitcoin, this pristine collateral, into these different vehicles, what is the upside opportunity for strategy? Well, it clearly isn't one times book, right? Like that's what the market is telling you. That the market's telling you this trade, this equity, Strategy Corp, is worth over 2 times book. So that means the value of holding that stack of Bitcoin is worth twice what the Bitcoin is worth. That's wild, and it's created this money glitch. You're seeing pools of capital, large pools of capital, not retail, but large institutional pools of capital, essentially bailing out from the fiat system and wanting to get onto a Bitcoin standard. Now, many of them can't buy Bitcoin. That's difficult for some pools of capital, but they can buy MicroStrategy, they can buy the convertible notes, they can buy the perpetual preferreds, and he's creating these products that work for different market participants.
Yeah, it's interesting. I have Mark Guthner on the live stream every Friday. As you know, he was a former pension manager at Pru, fixed income guy. And we were just simply talking about the fact that a 1% allocation to the zero converts, the MicroStrategy zero converts, could have added in 2024, I think we came up with 150 basis points of incremental performance, which basically takes you could be, a bottom quartile manager. In the fixed income world, you add 150 basis points to your annual total returns, and you literally go from the bottom of the heap to the top. That's the kind of gaps you're talking about. It's not like the actively managed equity world where the bottom performing fund is down, 10% on the year and the top guy's up 100. In the fixed income space, it's, a couple hundred bips between the best guy and the worst guy. And those guys can't buy stocks, but they can buy convertible bonds. What do you think the impact on vol in the space is going to be, though, with all of this? Because now we have a big upside vol seller in the form of Michael Saylor, whether it is the convertible preferreds or whether it's the zero converts. And Misty's got 3.6 billion or so in it right now. I was looking, so I guess the Yieldmax guys, and I only looked at it right before we started doing this live stream. They actually have a Yieldmax ETF on IBIT, which is the ETF. It doesn't actually. The assets are decent, but it's nothing big. It's not substantial on a relative basis. But you're getting a lot of premium sellers. So do these guys end up making themselves right because they're selling so much premium to the street?
Yeah, it's a great question, Mike. I'm going to take a contrarian view of this situation, which is Bitcoin is unlike any other monetary asset we've ever seen, unlike any other equity, unlike any other ETF. And the reason why is because you can't create more, right? Bitcoin is infinitely scarce. There will never be more than 21 million Bitcoin that ever exist. So what does that really mean? So that means that the more MicroStrategy buys Bitcoin, the more IBIT buys Bitcoin, the more corporate balance sheets acquire Bitcoin, the less Bitcoin there is to trade. Okay. And that's very different than anything else we've ever traded before. I mean, almost anything I challenge you to come up with an asset that you've traded where they can't make more of it if the price goes up. Gold, they mine more, right? Equities, they print more stock. Bitcoin, you can't print more. So what happens to the volatility when the tradable float begins to decrease, right? When the amount
that's like a short squeeze.
Well, but it's not even a short squeeze, right? It's just
no. But I'm saying that's what happens. Is in a short squeeze, what's actually going on is that the availability of one of the things that keeps securities relatively level in price, what market makers do and other liquidity providers, they have a theoretical value for the underlying asset, whatever it is. Presumably, they can either borrow the asset that they want to sell, or maybe they already own it and they say, I think it's rich enough and I'm going to sell it. But if you have a finite quantity and you have finite access to the quantity, what ends up happening is that many times as that basically the supply that's available to be transacted with becomes increasingly constrained, you end up seeing things get pretty wild. It's a short version.
And just to kind of throw the cherry on the top of the sundae, most short squeezes get resolved by the creation of new shares. Look at GameStop, right? They sold billions of dollars of new shares and were able to, they're able to monetize the squeeze. But in Bitcoin, that's not the case. So you could end up in essentially a supply shock squeeze, a little bit different than a short squeeze, right? This is a squeeze that's created by not enough available Bitcoin for the amount of buyers, and it's something that doesn't resolve itself. Now, one could argue that higher prices can solve the problem, and that's true to some degree. But I don't think higher prices can naturally solve a problem of a supply shock, right? The more you end up with sovereign nations wanting to own Bitcoin, states wanting to own Bitcoin, the largest corporations in the world wanting to own Bitcoin. And don't kid yourself, BlackRock, what do they have? 11, $13 trillion under management? That makes them the third largest economy in the world, hoarding Bitcoin. There's only 21 million, right? So look, if 21 million millionaires all bought one Bitcoin and said, I'm not selling it, right? What would happen? I mean, literally, what would happen? There would be no Bitcoin.
I mean, there wouldn't be any.
There wouldn't be any. And that's, it's that unique an asset, right? This is what hard money is supposed to look like, right? It's not what fiat looks like, but hard money should be exceptionally valuable because it measures your time, your energy, your work, right? Money is a value on your ability to buy things in the future, right? And as you continue to devalue money, right, it becomes you're devaluing your own energy, your own work. Bitcoin does the exact opposite.
I would argue. Yeah, I mean, actually, it's interesting. The area where I would probably, the distinction I would make, the reason that gold always served as a good store of value was that it's true that there was always going to be a little bit more of it because people mined it. So you're mining a little bit of gold all the time. But the reason that worked was because the population of the earth was growing, productivity was improving, the amount of actual mankind produced wealth was increasing. And so if you're thinking about, the numerator and the denominator, if they are both growing, then one can be fairly representative. There used to be a saying that, a good suit costs 1 ounce of gold. And that was probably true in 1920 and 1925. And it's probably true today. You could probably get a decent suit for $3,100. Maybe not, I don't know if it would be quite as good as the one that it would buy you back then, but it's not a bad representation. If you think about it, I think the average house back then cost $1,200, right? 1920 or something like that. And a gold, 1 ounce of gold was $20. So, you just do the math. You say, okay, well, that's 60 ounces. Well, where does that get us today? So, now you're up to, that's a couple $100,000, right? So, again, it was a far better store value. With Bitcoin, though, the increase, the underpinning supply of hard money is not increasing with the scale of economic growth. So what that means is that if real wealth is created, each unit, essentially, if you think of this as a claim on assets, it's going to be a claim on whatever that growth and that wealth is. I mean, if the wealth of the world went down, then your claim is going to also go down. But as long as we continue the same course of human productivity, if the amount of the denominator is the same, then your claim on assets only increases because the amount of assets is increasing. And that's actually the big distinction I would make between mined metals and Bitcoin. It was one of the reasons why, but as you approach 21 million, that's it. I mean, if you can imagine that the global economy is 5 times greater because of AI, for example, so all of a sudden we have significantly greater wealth. We've seen a lot more wealth created in the last century. Perhaps we have the same thing happen in the next century. Well, each one of those as a denominator of that aggregate wealth is going to be it's going to be a nice piece, I would say.
Yeah, look, I mean, I love talking about gold because, I was a gold bug before there was ever Bitcoin.
I remember when you used to you kept the physical. You weren't just buying the futures. You actually kept the physical. I remember.
That's right. And, I was a big gold bug, but ultimately you realize that gold has failed us. It failed us in 1933. It failed us again in 1971. And the real reason gold failed us, funny enough, is because of the telegraph, right? That it was the ability of banks to hoard the gold and then send back and forth claims, right, that killed the gold market. It turned it into a physical metal that people used as a medium of exchange into basically just a store of value that failed as a medium of exchange. And it introduced massive counterparty risk, massive trust issues. It's not portable, it's counterfeitable, right? Like so many of the characteristics of hard money are not represented by gold. But Bitcoin, which is now in the digital realm, and I think you have to come to grips with the fact that we have left the analog realm of the previous millennium, and we are now in a digital realm. And with Bitcoin, you have an ultimately auditable security. You can verify your Bitcoin 24/7, 365. It's transportable, right? Every one of the flaws in gold as hard money is really solved by Bitcoin as hard money. And that's why you're seeing, Bitcoin prices eating gold. And look over the last 10 years at the Bitcoin price versus the gold price, right? And that's going to go until Bitcoin finally does eat gold because it's a better monetary asset, right? It can be used, it's transferable. It can be used as a means of exchange. It's a store of value. Like every hard characteristic, I'm not going to go deep into, how the technology works. But Bitcoin solves the gold problem, and it's in the digital realm. So you can carry it with you. If I drop you right now, Michael, and I dropped you anywhere in the global south with $100 million of gold, you'd be a dead man within a week. Period. Right?
Yeah, I mean, it's interesting that you mentioned that because, of course, one of the things that happened was that when FDR passed that executive order, and then Congress followed suit, there were numerous lawsuits that followed that went all the way to the Supreme Court. Most of those who felt that what was going on was unconstitutional, they ended up losing. The Supreme Court ruled 5-4. And by the way, a lot of people don't realize this, but FDR actually planned on essentially shutting the financial system if he lost that Supreme Court case, and had already written the letter to the nation where he was basically saying, if I don't get to do this, then democracy has lost its way because the people no longer run the show. But of course, that's not at all what I think people were voting for when they voted him into office in the first place. But I guess my point is that in the midst of all of this, everybody had to give it up. It was all confiscated. You could keep some for jewelry. You could keep, I think, 5 ounces of gold. I think you were allowed to keep 5 $20 gold coins. Coin collections were allowed to be kept. Everything else had to be sacrificed. There were even, financial industrial companies that weren't U.S. based that had gold reserves that were also confiscated, and they too lost. There was a Swiss company that had, I think, $1.25 million worth, which doesn't sound like much today, but that's actually quite a lot of money if it's in $20 gold coins. And they sued and lost. They said, nope, you get fiat currency now. And oh, by the way, gold's not $20 an ounce anymore. It's 35, 36. I think 35.67 or something like that. So we do have a couple questions. Some of them might be related to Misty and Mr. and Bitcoin and things like that. There's a couple other things in here that I'm going to try to get to because I usually do try to. So Kyle says, Misty, Mr. Bitcoin is the money glitch, was the comment that Kyle makes. Well, I would actually suggest that as a quick response to that when you start seeing big dislocations in value between any asset pair, doesn't really matter what it is. It's true. It's telling you something's not right. And so the question you have to ask yourself, this is what I would suggest, is what do each of these two assets represent, and whose story do I want to believe, and why do I want to believe it? What would you say to Kyle?
I would say that most dislocations, right, most glitches in financial assets get resolved in very short order. What's unique about strategy, MSTR, MSTY, is that this glitch is not resolving itself. Matter of fact, it's getting worse. Right? You have new big companies. I mean, when you think about Cantor, SoftBank getting together with Jack Mallers to start a new company that's going to issue new products. I think we should talk a little bit about bit bonds for a second, because I think they're really important. So there was a company by the name of New Markets Capital that through the Bitcoin Policy Institute made a presentation in Washington, D.C. And they suggested that when the U.S. government goes to refinance its $9 trillion of debt this year, they should take $2 trillion and refinance it into a bit bond. So what does that mean? So that means that the government would refinance $2 trillion.
Two of the 9?
2 of the 9.
Okay.
So you'd end up with 200. So they should take 10% of it, $200 billion, and buy Bitcoin. Now, obviously, if you go into the market and buy $200 billion of Bitcoin, that's going to move the price higher. That's a significant amount of Bitcoin. That represents 10% of the 2 trillion. That Bitcoin would then stay in escrow for 10 years, with 50% of that Bitcoin going to the government and 50% of that Bitcoin going to the investor. The government, instead of issuing a 4.3%, or I guess 4.4 now today, 10-year, they would issue a 1% coupon. Okay, and they'd be able to do so because they're adding this Bitcoin kicker to your bond.
So effectively, the U.S. Treasury gets into the MicroStrategy business.
But let's look at the results. Okay, the U.S. government is now able to push the duration out 10 years, and they're able to borrow with a 1% coupon.
Is that where they think the appetite would be? I mean,
I think that's being generous. Because
so
remember, once you start this and you go into the open market and buy $200 billion in Bitcoin, and that forces other entities to start incorporating hard money, Bitcoin, into the broken fiat system, right? That begins a flywheel effect where you have more and more demand for Bitcoin being put in 10-year escrow to finance corporate actions, to finance, right? It won't just be one government bond, right? Because the second that government bond begins to perform as you know it will because of the flywheel effect, right? It's going to ripple, go through the financial system. It's going to force foreign governments to do the same thing. It's going to force corporations to do the same thing. And then, we should talk about what the consequences would be. But if you
Do we
understand,
want foreign governments to do the same thing?
well, they're going to
Or do we
have to.
want.
They're going to have to, right? The whole world is going to have to get off a fiat standard and start positioning Bitcoin as the hardest money that exists into their financial packages. It's the only way to move forward. It's the only way to get off of this broken system. Now, let's talk about the positives. If the US government were to do this, and Bitcoin would grow just modestly, 20, 25% CAGR versus the 40 to 50% CAGR we've seen, right? The net result after 10 years would be a bond that yields something north of 10, 12%. Okay. Now, what does that do to Social Security? As you mentioned earlier, what does that do to pension funds when they're able to buy a bond that yields 12%? What does that do to Medicare? What does that do to all of the underfunded liabilities of the US government? Well, it begins to fix them, but it's not without a cost, right? The cost would be, what does it do to the stock market? If you can get 12% in a government bond, what's the value of a stock? What's the value of a home? What does a home mortgage look like if a government bond is earning 12%? So we can go right down the line. We can see all the positives, but there's also major consequences. And Mike, what's crazy about this story is I don't know if there's a way to avoid it. So the government might not go first, but somebody's going to create this structured product that yields 1%, buys 90% treasuries, buys the Bitcoin, right? And that structured product is going to start yielding north of 10, 12%. It's a no-brainer, right? It's going to have guaranteed return of principal.
So this is, so what I was talking about in the beginning when I was talking about the average high yield manager allocating just a fractional, call it 1%, and getting 100, 150 basis points incremental investment performance. And that was just buying the zeros. It's not actually buying Bitcoin itself. That was just buying the zero converts. Now, their performance actually tended to track. One of the things I actually want to quickly show, just for people who are interested, because one of the questions we got here regarding MSTY. So the Andrew O says, good stuff. How realistic would we expect the MSTY yield to remain at its insane levels? So I just want to, I don't know how well you guys are able to see, and maybe Scott, you can tell me what you're seeing on your screen right now. Does it look like a regression chart?
Yes.
You see? Okay. So what this chart represents, and hopefully you guys can make this out, this is a regression of MicroStrategy to MSTY. So this is the log returns versus the log total returns of MSTY. Why the log total returns of MSTY? Because MicroStrategy doesn't pay a dividend and MSTY pays a big one. So if you try to, for anybody who's going to try to do this at home, you got to look at the total returns, because if you're only looking at the price of MSTY without incorporating the dividends, you're going to get these wild days when it trades X. So basically, the last dividend was, I can't remember, it was like 13% of the value of MSTY at the time that it was paid. So you're going to get these really wonky kind of results. So you got to make sure that you're looking at the total returns. And what you get, and what you can see is that if you own MSTY, you have a huge exposure to MicroStrategy. Okay, so let's be very clear about that. Is it the same as owning MicroStrategy exactly? No. It has lower volatility. It's about 15% lower volatility owning MSTY. And that makes some sense, because if you're selling premium, you're selling a lot of premium, two things are happening that compress the volatility of what you hold relative to the underlying asset. One is the premium you're collecting. So if you're receiving regular cash distributions over time, just like if you have a bond that pays quarterly coupons, it's going to have lower volatility than a similar maturity bond that is a zero. That is to say, a bond that pays you nothing until the end, right? So this, if you're receiving regular cash distributions, the volatility of the asset is going to be lower. The other is that you're selling off the upside, right? You're owning MicroStrategy and you're selling upside calls. So that means that your exposure on the upside is going to be capped. And if you look closely at this chart, you can kind of see that here. You'll see that there's a couple data points over here that, they're not tracking the line as closely. And that's because MSTY is short calls in MicroStrategy as MicroStrategy goes up. But what's funny, I actually created a fourth order polynomial to sort of follow this track, is that it tails slightly to the upside. And Scott, when you spoke to Scott Snyder, the head trader, and to Michael Venuto, they explained why it actually starts to come back. Your returns actually start to come back on the upside. So the characteristics of MSTY's performance returns might change because of lower volatility, but they're changing their strategy, aren't they? What are they doing differently now?
Yeah, so they've adapted to slightly lower volatility. As volatilities come in, they began to add vertical call spreads. So they're selling verticals, thus giving them some upside kicker, right? So as the way they view, the way their perspective on the MSTY trade is they have a target income that they're trying to bring in every month to make their dividend, right?
How much is that?
I'm not exactly sure. I guess 8%, somewhere in that range, but I'm not. I don't quote me on that.
Mm-hmm.
So once they've achieved their target, they can go ahead and sell verticals and give themselves exposure to an upside rip in MicroStrategy, and they've begun to do that as those upside calls have come down in value, right? It's also forced them to move closer to the money. So when they're going to sell a vertical, right, instead of, well, let's just put MicroStrategy or strategy at 400, instead of selling the 410 call, maybe now they're selling the 405 or the 400 call and buying the 430 or the 425, right, to give them exposure to the upside move. So it's very interesting. Look, these are very smart people, right? Scott, as I mentioned earlier, he's creme de la creme of options traders. They understand this game. They get it, and they have a goal. They have a mission, and they're going to accomplish their mission. Now, Mike was very clear that MSTY,
Mike Venuto, you
yes,
mean the head of the yeah,
was very clear that MSTY is heavily leveraged to MSTR, meaning that in a downside move in MSTR, MSTY is going to get hurt, and it's going to get really hurt, right? So this isn't without risk. And it's important we kind of lay that out. But I think...
Well, my work suggests it's like 74-ish, instantaneously 74%. So if you buy MSTY and MicroStrategy drops, let's just say that it drops 2% in a day, you should expect to be down 1.5% on your MSTY.
I think that's right, Mike. Yeah, that's right. No. And so you have downside exposure. Now, the real question becomes, is there a way to collar MSTY? Is there a way to capture, let's say it's paying 80%, I'll be happy to take 30% and take the downside risk exposure away. And that's what I've been working on. I've come up with a number of good ideas. None of them have I had the chance to really dig into because I really didn't consider buying MSTY until after my conversation with them. Now, in full disclosure, today I went out and bought MSTY, right? I just felt like I needed to support the organization, and I really I was thoroughly impressed.
I bought a little bit today too. So for those people who are watching this live stream, and Scott's a longtime options trader. He was actually on what we now call the CBOE. It used to be called the CBOE, or the Chicago Board Options Exchange. They changed their name officially. So now it's CBOE. But you spent years down there at the same time that Scott Snyder, who I think I overheard was the DPM at Amazon, among other things.
Mm-hmm.
And now he's one of the biggest options traders in the world right now, because MSTY options are better than 10%, I think, of the open interest in MSTR as we speak. And then they've got all of these other products as well. So this guy he's clipping off 5s, 10s. I saw he's got 80,000 contracts on the line. One of the questions that I had when I looked at it before is that if you looked at their holdings, you saw no underlying. It's solely a buy right fund. And I didn't understand why that was. I don't think you did either, but they explained it to you. Why are we seeing that? What's going on there?
Yeah, so it's a regulatory issue with them. They're not allowed to own the underlying. So what they're doing is that they're using synthetics. They're creating synthetic long stock using a long call short put combination. And they're doing that for a regulatory reason. And then they're holding treasuries, right? So the cash that's put into MSTY is held in treasuries. Right? It's really interesting. I mean, as we talked earlier, we can never really understand the regulators on this one. It doesn't really make much sense. But yeah, that's what they're doing. And then to the point that they don't ever want to own MSTR, they're using European flex options on their short puts, so they can't get assigned. Right? Like they look, and these guys know what they're doing.
Not their first rodeo.
No, sir, not their first rodeo.
Yeah. So the interesting thing is, because normally on this live stream, when I talk about some of these simplistic overwriting strategies, I'm not characterizing theirs this way, but some of them are, and I've said many times you can go off and replicate. Oh, yeah, that's right. So Joe Hartman is bringing something up here, which I think is quite interesting, too. There's also the regulatory issue with the disclosure of the return of capital, which is only an estimate, if I remember what Michael Venuto was saying on the X Spaces. But
I asked that question as well. So here's the deal. They're kind of stuck between a rock and a hard place on this concept of return of capital. So a lot of people will look at their monthly dividend statement and say, wow, they return 95% of capital. Well, they're not really profitable. Well, that's because the SEC is very strict on what they call profit and what they call return of capital. So they always err on the side of saying, oh, well, it's return of capital. And then at the end of the year, when you get your tax statement, is when you find out how much was actually in profit from the options, from the short calls, and how much was really return of capital. So it's not an accurate measure. But again, this falls into this regulatory bucket of, I could never explain it, but that's the way the rules are written.
So I as people who are watching this live stream may know, I ran and actively managed 40 Act ETF. So one of the reasons I'm imagining this is the case is because, so you have the whole concept of dividends, right? You distribute dividends to, let's say I own, which is what I did. I ran a fund, some of those stocks paid dividends, then I had to distribute those dividends. So in the case of MSTY, right, they're never collecting dividends per se, right? So, no. But they are distributing them. Now, what is the origin of those dividends? Well, the origin of those dividends is coming from the purchase and sale of options. So, in a sense, I guess, I often try to get into the head of regulators, and sometimes they don't really have a concept of these things anyway, but there are rules that are written, and you need to kind of stuff a new reality into an old rule set. Don't forget that a 40 Act fund is so named because it's named after the 1940 Investment Act, right? So that was long before there were any options trading on any of this stuff. So, we're oftentimes dealing with rules that obviously didn't conceive of the reality of financial instruments today. So I'm imagining that kind of the logic has to do with the purchase and sale of options, realized gains on those options, and how we're going to attribute distributions associated with those gains. That's my guess on what the logic of all of this is, but I think that's an important issue. The short version is, though, as people are looking at this thing and they're saying, okay, this and any similar instrument where you see big dividends being paid, and there's this issue about the net asset value essentially being distributed. The price of MSTY's down 80%, but the total returns, if you had simply taken the dividends and put them into treasuries, is 90% to the good. And if you'd reinvested it in the equity, 146 or 147% to the good. So they're clearly not just taking your money and returning it to you, because how could they just simply take your money, return it to you, reinvest it, and make it 2.5x what it was a year earlier? You can't, obviously. That would be It's like the Three Stooges when they're paying each other. Oh, I owe you $20. I owe you 20, and they all end up satisfying each other's debt. Yeah, so it's not they're not just passing the same $20 back and forth. There's actually real volatility risk premium being captured here. Let me see here. We've got a couple other. So, Triple C124, the Bitcoin community loves Scott, aka DarkSide. Yeah, I can certainly pick that up. How many people have listened to that space that you did only a couple days ago already?
So far, 28,000.
28,000. And you had some notables on that.
Yeah.
Name some of the people that were participating in that last one while I bring up some of these other questions here.
We kind of regularly have, I do spaces all the time with Gary Cardone, Grant Cardone, big names, and names that you might not be familiar with in the TradFi space, but big in the Bitcoin space. Puncher, Lauren. Yeah, we have a good community. Come over and give us a follow. We do a show every Monday through Friday at 11:30 Eastern Time, 8:30 Pacific Time. It's called Bitcoin Today. That's a space on X, and I host spaces on a regular basis. Gary Cardone hosts spaces. There's some really great content over there.
So yeah, this is unrelated to Bitcoin, but I always like to try to grab a couple of questions. Somebody just pointed out that Uber just broke above the all-time highs today. All-time high was 87, traded 88.10 last. We got a big rally today. It'd be nice to see a little bit of a follow through. Obviously, I was on Fast Money on CNBC last Friday. And one of the things I specifically said, Melissa asked me, she said, what does the tariff number need to come down to with China for the market to view the conversations that were taking place in Geneva favorably? And my response was, it doesn't matter what the number is. I said, what is going to matter is whether when people come in on Monday, they feel like some meaningful progress is being made, or even that they're saying we're going to have another conversation. Because up until now, the Chinese had been saying, whenever the Trump administration was saying, we're in talks, Xi's government was saying, no, we're not. We're not doing anything. We're going to stay. And the meeting demonstrated that they are having talks. And now they're both saying that they're going to have more talks. So the market absolutely got what it wanted. It's not about the number. And by the way, it should be pointed out that, we already had substantially higher tariffs with China after Trump 1.0 going into the Biden administration. And some of those tariffs were not taken down. I think people don't understand this. They somehow think that, Biden was like, oh, free trade. You can, there was what was called the de minimis exemption. I don't know if people are aware of this. The de minimis exemption basically said, I was about to say, in the movie Top Gun, the captain of the aircraft carrier says you're going to be flying cargo planes full of rubber, out of Hong Kong. In any case, if worthless stuff, they weren't paying meaningful tariffs, but we had some other ones. I was just curious what your thoughts were on that conversation between the United States, China, and the market's perception of it.
No, I think you're absolutely right, Mike. I guess my take is more along the lines of fair trade is different than free trade, right? And in order to have free trade, you need to have fair trade. And I think if Trump and his team are able to, even at the margins, improve the fairness of trade, that is going to be a boon for the United States, right? So I think you're right, but I also think that they need to like they did with the UK, and I think they will. Look, I think he's going to continue to post wins because in the end, these are rational actors, right? That's the way I view. I view China as a rational actor. I view almost all of these countries as rational actors. And in the end, they're going to do what's best for themselves. And we're going to do what's best for ourselves. So look, if we come out of this, 20% better than we went into it, that's a huge victory for the United States. And it'll be okay for the other countries, especially if they open up their markets and we force them to be a little more free. right? One thing I'd like to see, I'll just land the plane here, but one thing I'd like to see is I'd like to see free speech get spread around the globe. Right? I know this is all about trade, but at some point, you should be able to talk. And what's going on in Europe right now, what's going on even in the UK and in parts of Germany where they're outlawing parties and going after the political opponents, that needs to stop. But hopefully this is a first step towards making the world a better place.
Yeah, it's interesting because obviously I want also to see fairer trade. I think it's important for people to remember, and I've said it on this live stream before, but I know we have a couple people watching who haven't before. When you think about U.S. GDP, and this goes to something that Scott was talking about earlier, that if you cut government spending, you cut GDP because government spending is 20% plus of U.S. GDP. It's actually probably much more than that because
Yeah.
U.S. GDP is about 30 trillion, and the U.S. federal government alone is spending 7.2 trillion. And if you factor in state, local governments, the number goes up even more. Now, before everybody has a huge fuss about that and says, "Oh, but there's also intergovernmental transfer payments." Yeah, I know, but that there are. Let's remind ourselves: there are state income taxes, there are state property taxes, and there are local taxes. So federal government is not the whole thing. So it's much more than 20% of GDP. How do we resolve this when you have a $2 trillion deficit? Well, I've said this before. GDP is C plus I plus G plus NX, where C is consumer spending, I is investment, like corporate investment, G is government spending, and NX is net exports. Now we don't have net exports; we have net imports. But if we can reduce our trade deficit, which is currently about $1 trillion a year, the bulk of which is with China, if we cut that even in half, then you would also be able to effectively cut government spending by about $500 billion, and you'd have no net effect on GDP. Now, the last GDP print disappointed a lot of people. I think they need to bear in mind that we also saw the largest trade deficit in the nation's recorded history going into that print, and that's because there was a lot of tariff front running going on. Well, if you front load the imports and now you start to see some normalization, what's going to happen on the next print? Well, it's probably going to revert. At the very least, it's probably going to revert back to the mean. So my expectation is that from a GDP impact, that's going to be mitigated over the course of time a little bit. The other thing is that, and I know Scott feels this way, anybody who has more classical liberal leanings does not like trade frictions of any kind. We don't want to see taxes. We don't want to see regulation. We don't want to see countries saying you can't export your goods to us and you can't export yours to us. We don't want that. But we do need to find some balance. We are living in a legacy trade system, the construction of which was designed to help war-torn countries coming out of World War II, basically Marshall Plan writ large, to help bail out Germany, to help bail out Japan, and all of these other countries essentially able to rebuild by exporting their goods to us. And that was a noble effort. But its time is well past by now, and we're doing very little. Like every government program, once it's in place, it has a constituency that just doesn't want it to end, and it needs to. So that, let's see, I want to just quickly see what else we have here, because we have a couple of things here. Let's see. All of a sudden, the media wants to believe what the CCP says. I mean, the real thing I think for all of you viewers is make up your own minds. Some people are going to say some things that are accurate, some are inaccurate, and some people are wrong unintentionally. I am wrong unintentionally all the time. I think Scott and I had talked about the construction of some of these ETFs like Misty and said, now why the hell are they trading reversals instead of buying the underlying? That doesn't make any sense. It's like adding additional friction. And then, of course, there was a reason. So sometimes there's a good reason for things, and we're not right about it. But, yeah. So, oh, wow, we've chewed up already a full hour here. Let me see if we had some other questions that we could get to, because most of the, let's see. So on the Uber front, sorry, because that's what we were talking about. You're considering the long August par calls. So buying the August 100 calls post the next quarter earnings release. So first things first, I would say about that. Number one, I don't like being short options going into an earnings print in most of these types of stocks. We've seen, taking a look at a lot of them, that in fact, as big as the implied moves were, they weren't anywhere near big enough. So I'm an options premium seller at heart, probably, I think, in the general case, but I don't like selling into events that much. How do you feel about it, Scott?
Yeah, I'm with you. I mean, look, options are tools that should be used to hedge. They should be used for economic purposes, right? They're not gambling products. At least that's my perspective, Mike. So yeah, for me, I'm going to stick to using options for what they were intended. But with the obviously with the proliferation of zero date and all the different things that are going on, people are using them to speculate, and it's really tough to make money speculating in options.
Yeah, but if you're going to own premium, then own it into the catalyst. This is the way I would kind of think about it. Options are a form of insurance. It's insurance against bets of the underlying going up or down. And you can ask yourself this question: if you were an underwriter selling home fire insurance, for example, but you didn't write your policies for a year or 2 or 5, instead you could write them month to month. And let's say that California, where I live, is the area that you were looking at. Well, if you had an opportunity to sell fire insurance, but you could exclude the time when the Santa Anas were blowing, you might say, I kind of like that idea. I'll take a lower premium to sell during the rainy winter months. And, I don't care how high the premium gets. When the wind starts blowing and it gets hot and dry, I don't want any part of that, no matter how much the premium is, because it might never be enough. So it's going to be case by case. In something like Bitcoin, where it isn't necessarily a specific catalyst, although Scott has pointed out a couple things that could obviously propel it if news came out, like a Bitbond thing would be enormous, right? So don't sell calls in Bitcoin when that happens, if it happens. That will just be my first suggestion. If you're interested in being long Uber, I like this. I was looking at Lyft, and I think I mentioned it on this live stream a week ago. Somebody who was long in the money, at the money, and out of the money calls in Lyft last week asked, do you like this trade? And the thing I pointed out is I said, it's a 12.8% implied move, and it's not enough. I said, those options are very fairly priced, very fairly priced. Holy cow, am I glad I said that too, because the stock went up huge thereafter. I would have felt terrible if I'd said something different with the benefit of hindsight. But yeah, I think that's fine. We can see that this thing's really moving. So I'm good with that. All right. Well, I know that let me see, where is that question? PC. Oh, here we are. Yeah. I have Microstrategy and selling December calls against it, and also buying 60-day to expiration with the same strike price due to contango. What is your recommend? So that's really interesting, actually. I'm going to pull this chart up. What do you say to that, Scott? So we got somebody here who's usually, I would say, people like to sell shorter dated premium because of the decay rate. But you're right, that longer dated premium is kind of elevated. Do you think this is a way to capitalize on anticipated vol sales for institutions like MSTY?
This is the MSTY effect, right? So This is why I've been buying long dated options in MicroStrategy, right? Personally, I think they're going to perform. I think that this volatility is still low, right? So I'm not sure I would sell these or even the leaps. I think they continue to go higher, because I think as Bitcoin goes higher, volatility is going to go up. It's not going to go down. But obviously,
what about the idea that, this is pretty steep contango, to PC's point.
Yeah, but I still don't like being short the Vega, Mike.
Yeah, what I was going to say is, if you had the inverse of this trade on, just hypothetically, so let's say I own 45 to 90 day premium, and I short 180 to 270 day premium in MicroStrategy. And by the way, I'm very, very much aware of how long end vol can go against you. I traded Philip Morris back when the tobacco litigation was going on,
Hmm.
and everybody on the floor ended up short the leaps, and I didn't want to sell any of them, and I could not get them back. I was sending Smith Barney brokers into the crowd to try to buy them back at $1,000 a time, and I could hear John McGowan yelling at me from across the red room.
It's
He
funny.
knew it was me trying to buy that stuff back. So what I was going to say is the flip side of this is that if you're getting good value for money on the realized side in the front, and actually that's what we should be taking a look at. I don't mind being long gamma, and if you wanted to sell some longer dated stuff because it's steep, anticipating future sales from MSTY, how's this shaping up? So let's put this in. I'm gonna put 2 months. So you said you're doing 60-day. See, this is the only. So look at the realized versus the implied here. You're getting good value on those 60-day options because you're paying 70 vol, and it's realizing, it's on the high side of the century.
Mike, and the realized vol is a bit of is a miscalculation, right? And let me
Hmm.
explain to you what I'm thinking here. Bitcoin, unlike MicroStrategy, trades 24/7, 365, right?
Hmm.
The realized vol that you're looking at is just the volatility, the realized vol of MicroStrategy, which trades, on market
Open to
hours.
close.
That's right.
Open to close.
So
So
if
it has what we call that jump risk.
That's right. So there's a correlation between Bitcoin and MicroStrategy that enables long gamma traders to be trading, either Bitcoin spot or futures 24/7, 365. So the realized volatility is too cheap. It's way too cheap.
Yeah, so oops, I put this in incorrectly. So that's another interesting thing. If you are long, so anybody who trades gamma here, what do we mean by that for those who are uninitiated? Gamma is when and typically you're going to be doing this at the shorter end, the near dated maturities. You own options, and then you adjust your position to remain maybe delta neutral or towards a target delta. So I would not encourage people to just say delta neutral. I would say you probably want to lean delta long. But let's say you have a target delta. So you have a bunch of gamma and you say, okay, well, I want to manage to a 50% long delta. So as it goes higher, your delta rises, you sell some off. As it goes lower, you buy, right? So if you are trading MicroStrategy options, you can establish, like that regression chart that I had earlier, comparing MSTY to MSTR. You can do the same thing with Bitcoin. And assuming that you're not going to get like good, depending on your arrangement. I mean, if you're a hedge fund and you have a good relationship with your prime, maybe you're getting good cross margining. But my point is you can actually hedge some of those deltas by understanding the relationship between the way Bitcoin trades overnight and MicroStrategy trades during the day. And so what I'm going to do here is just see if I can quickly get so this is the volatility. I'm going to kill this. So this is the volatility of Bitcoin, which trades more continuously, as Scott was pointing out. So MicroStrategy's volatility is going to be based on an open high-low close basis, usually, for the way most people think about it, or close-to-close basis, the way Bloomberg is establishing it here. That's all they're doing, is just looking at PX last for one trading day versus the next. So that's something. So PC, I'm not sure that Scott and I agree completely on this. I
Well,
would say that
Mike, one other little piece to the puzzle here, which is that 85% of Bitcoin's moves happen during non-trading hours, non-US trading hours. So that means at night or over the weekends. So it'd be
yeah.
interesting to do a study on MicroStrategy gaps, right? I think that would be really, really interesting.
I will do that. I'm going to do that actually before the next show. And I'll give whatever results I do, I'll hand it off to you. You can maybe use it on the spaces. I guess my point is that it does seem to me like the short end volatility is fairly reasonably priced if you're going to trade it on the long gamma side. And that makes some sense because we have a big institutional seller out there in MSTY. They're selling, whatever. It's a $3.6 billion fund. It's more than 10% of the open interest of MSTR right now. So, and the beauty of options is it is not completely zero sum. People think that it is, but that's not true. I have seen circumstances where there were people who were long vol in a product and people who were also short vol in the product, and based on the way they traded it, they both made money. I've also seen the opposite, where long or short, the guy couldn't figure out a way to make it. So I think that's something interesting. So yeah, John Anderson says, excellent work, MSTY Long, a simple way to get extra money. Yeah, I mean, look, as I said before, it's long MicroStrategy. If MicroStrategy gets hit hard, this will get kicked in the teeth, make no mistake. But the difference is that you are, of course, getting cash distributions over the course of time, and that reduces its risk because it's a lower delta, lower duration way to play. So unless, of course, you reinvest your dividends, in which case it's not lower duration, but you get my point. Okay, Joe Hartman says, how can they capture downside risk and profit both ways? So actually, they have a downside strategy as well, don't they? Oops. Scott, I think you muted.
Sorry about that.
Oh.
Hit the button by mistake. Yeah, it's called Winter, WNTR. And it's the inverse of MSTY. I do like the choice of names, by the way.
Yeah, right? Winter's coming. I take it this one's much newer based on what I'm seeing here.
I think so,
yeah. Okay. So there's a way to play it both ways. So, just a quick point for people who are wondering this. If you have a really high volatility product and you're selling premiums routinely, it is possible for you to essentially generate some positive returns if the thing's chopping around. If it goes a little bit higher, a little bit lower, even if you are long delta, because the premiums that you're getting. Now, if it really, if MicroStrategy got cut in half, make no mistake, the premium that you're collecting in MSTY is not going to mute that move. You're still going to. I mean, you saw the regression chart I had up before, so I think that's really important for people to remember. This is not a, Scott and I have no interest in MSTY other than our interest in the Bitcoin complex, our experience with the people who run this thing. I don't have any other than having listened to them on his spaces, but I know where they come from. These are real guys, but they're not magicians either.
No.
So it's not like it's free money. We're certainly not saying that. So Connor McCullough says, would absolutely tune into a weekly show to watch you two explore Bitcoin complex options chains and talk trade opportunities. Well, it's funny that you mentioned that because Scotty and I are very much looking into better ways to trade the complex on the vol side. And the more people start trading this and the more products that are created, the more opportunity that's going to create as well. Pricing dislocations take place all the time. And this is the way that they take place. New products are introduced. People are trying to understand the dynamics of how they're supposed to interact with each other, and they're also trying to capture the fundamental underpinning story that's going to drive the prices of those assets. And actually, the biggest mistake I ever made when I first started trading options was that I didn't look at the big picture. We were told to trade delta neutral. Make a market in options. Don't screw around with anything else. And that was probably the biggest mistake, because if I had just leaned in a delta direction, Parallax is a volatility shop here in San Francisco, had a phenomenal track record. The biggest mistake they made was not leaning delta long in 2009. Had they been, they had otherwise an uninterrupted track record. They just got a little caught out in the V bottom. I think that's Amar Knoxville says, this is a very educational show. Always good stuff with Scott. Sky3 Rant. Scott, if the broader market crashes, do you see it bringing Bitcoin down with it?
So that's a great question. In the short term, yes, but in the long term, no. And I'll tell you why I say that, because I believe that any type of market dislocation will be met with a Fed reaction and money printer going burn, right? I think that the biggest threat to the equity markets right now is the long end of the bond curve. Right, I see that as being extremely disruptive, especially if we kind of head towards 5%. I think that's the number where the equity market gives up, and we put the Fed into even a tighter box. And ultimately, look, there are very few tools that they have left in their shed, right? There's yield curve control, there's QE. They'll probably come up with a new four-letter acronym for whatever program they're going to launch, and say, well, this is definitely not QE. But in the end, look, there's only one way out of a fiat-based Ponzi scheme, and that's to print more liquidity, right? Like, there's no other way out other than print. So whether it's printing here or printing in Japan or printing in the Eurozone or printing in the Swiss National Bank or swap lines or whatever, they want to call it, we're going to get to the next big print. And the one thing you can bet on is the next big print will be bigger than the last big print.
They always are.
They always are.
They have to be, because the scale of the problem keeps expanding. If the thing you keep doing is blowing the balloon up bigger, well, it's a bigger balloon. It's, we're not letting air out of it slowly so that we can actually contend with it. So we had the TARP program. I thought of this while you were just talking. So the Troubled Asset Relief Program. I'm kind of thinking of this as in the harp program, like playing your golden harp. This is how you head to the pearly gates of money in the United States. This is, look. I wish it were not thus. I'm not a huge conspiracy theorist type of person. I'm just simply looking at the numbers, and if somebody can explain to me how this works out some other way than what we describe, I like to be an optimist. I would love to hear it. Somebody thinks that there's a good solution. As far as if you can't find one, though, then you have to try to mitigate the risk. And mitigating the risk means understanding the other things that are available to you to do so, and this is one of them. Okay, so the young gentleman says, thanks, Mike and Scott. Michael B., friend of Puncher. So it seems like a number of people. Max Convexity. Hello from Austin, Texas. Great show today. Oh, I miss Austin. Although this time of year it's getting a little hot down there, so maybe not. I used to have a car that wouldn't go into reverse when it was over 95 degrees. I had a 911 Carrera S. I had to open the driver's side door and use my left foot to back myself out of a parking space at the HEB parking lot in Westlake Hills where we used to live. But I sure do miss it. You were in Austin for a while yourself.
Yeah,
right?
short time. I prefer Vegas. Like, if it's going to be hot, let's get up to 120. Yeah, the last summer, it was so hot that I have an electric car, and the computers turn themselves off to protect themselves. And you literally,
overheating.
Yeah, just from the 120-degree heat and being in the sun. So that's hot. That's really hot.
Yeah. You also like to race cars. I don't know if you're still doing that. You're doing a lot of track days.
Unfortunately, as you remember, that didn't end well for me. A couple back surgeries, a neck surgery, and one very very violent instant deceleration syndrome situation. And now I stay out of the race cars.
All right. Well, lots of fun while you had it. Okay. We. Where is Steve's question? Oh, okay. All right, I'm not quite seeing that one. I can't quite make it out on the screen, so I'm going to see if I can find it, or you can just read it out to me. Everybody who's watching. Oh, MSTR, MSTY. Oh, so are we tracking the MSTY holdings? And the short answer to that question is yes. Most ETFs have to report their holdings with certain regularity. Most of them, it's actually overnight. So and again, I had to do this myself. We would upload our positions end of day. They would get booked, and then they get reconciled. And they're pretty good about it. The people that are running these things, it's a very well-oiled machine. So I'd expect this to be accurate.
Yeah.
Now, Scott, you touched on this before. A lot of what you see when you look at MSTY's holdings, you're looking at these and you're probably thinking, oh, I could trade the exact same option. But generally, that's not going to be true because they're trading flexes. Do you want to just quickly explain to anybody who's watching who didn't quite pick up on that what a flex is and why they're interested in trading those instead of the contracts that you and I would normally click trade.
Yeah, so a flex option is an option that's created via like a Bloomberg request for quote. You will tell your broker you're looking to create a specific option that expires at a specific strike price, a specific time period, a specific date, and then in flexes you could actually request a European option or an option that's not assignable, exercisable. And they're doing that because they don't want to end up being assigned on short puts inside of their synthetic, their reversal, and then they end up breaking the regulations. So they figured out a way to use long call, short flex put, European flex put, right? And that's the way they're creating synthetic long stock. One other point I'd make, Mike, to the earlier question. Look, these guys are remarkably transparent, not only in the fact that they put their trades on the website, but the fact that they would come up on a Twitter space and take questions, right? That's so refreshing. Look, you and I have been doing this a long time, right? The one thing about Wall Street, they love to be opaque, right? These guys are the exact opposite. I was so impressed that they were able to do this and be careful, not answer the wrong questions. Wow, what a new world we're entering into with the level of transparency. Hats off to Yieldmax, Mike, Scott. You guys are rock. Thanks.
Yeah, I was actually pretty dumbfounded by that. I mean, it's pretty common, as you point out, for people who are on the street, especially guys who are swinging around a lot of capital like these guys are, to play it really close to the vest. But they talked about the risk associated with the product, how they do it, how they mitigate risks, how regulations affect what they're trading and why. And to your point, so this is an important thing, you don't need to trade a flex if you're buying an American option because it is up to you, the holder, to establish whether or not it is exercised. By contrast, if you are short an option, like short a put, for example, it is always going to be up to the counterparty to decide if and when they're going to exercise it within the rules that permit them to do so. If it's a European option that's only on expiration, you close the option before expiration, you will never be assigned. And the funny thing is that this has nothing to do with a capital requirement. I want to make this clear about the Yieldmax strategy. They actually are fully funded. It's on the cash side. It's all in U.S. Treasuries. The reason they do this has to do with something associated with concentration risk when the 40 Act rules were written, which basically says that you can't have over a certain percentage of your assets in a single security. Now, they're running this across a whole swath of different options on the same underlying, but if they held one big block of the underlying, then it would throw them over the rules, even though the effective exposure is no different. And one of the other things that I thought was very interesting that I overheard them say, you said they're trying to manage like even their interest income really carefully, aren't they?
Yeah, I mean, even to the point that they were looking to, capture an extra 15 or 30 bips on their treasuries. Again, just very impressive stuff. I couldn't have been more impressed with the team. Yeah, look, I'm a proud owner now as of today.
Yeah, I bought some today too. And like I've said on this live stream many times, that generally I don't buy other people's options managed strategies because you and I are options guys. Our attitude is I would much rather manage it myself and also not have the street front run some huge block. But the fact is that these guys are, there's a lot of sort of moving pieces to this that they make it relatively easy. The 1% that they're making to manage the assets, I think, is actually kind of a bargain. I traded a little bit of options on MSTY itself. So I'm long MSTY, and then I trade a little bit of options around the outside. Just because I want to sort of see what the price action of the behavior is. That reminds me. So I want to show people, because I often show people volatility surfaces. I just wanted, before we break, I just wanted to quickly show you guys the skew in MSTY versus MSTR versus IBIT. And I'm putting IBIT in here instead of Bitcoin because actually there isn't a really good Bitcoin proxy complex for us to take a look at. So this, I think, is kind of interesting. So what are we looking at here and why? So this is something that Scott referred to before. Microstrategy, kind of a levered play on Bitcoin, IBIT, an ETF proxy for Bitcoin, and this is MSTY. And you're going to notice that the skew, the smile or the smirk for MicroStrategy and Bitcoin are pretty close to one another. MicroStrategy is a little bit higher because it's got leverage, right? It's essentially a levered play. But the upside here on MSTY dips down pretty steeply. Why is that, Scott? And do you think it dips down enough or not enough?
Well, the market doesn't lie, so I'm going to say it's probably accurate. Look, they're going to make it so that you can't easily collar MSTY, right, and capture the dividend. I think so. I think that's the natural desire of the market would be to sell, call, buy, put, own MSTY, figure out a way to capture 20% dividends, right? So I think that's a reflection of the anti-collar play, or at least making the collar much more difficult to apply.
So it's interesting because, so from a fundamental standpoint, I want everybody watching to think about this from time to time. I talk about this when I talk about implied volatility and realized volatility for related assets or very similar assets. So for example, if I'm looking at Deere and Caterpillar and the two of them are essentially selling similar products into similar markets, similar price points to a similar demographic of similar quality, but one has a lot of leverage on the balance sheet and the other has a lot of cash, then clearly the one with a lot of leverage should have a higher volatility than the one that has a lot of cash, all else equal. Ceteris paribus, as they say. With respect to MSTY is selling upside call options on MSTR, on MR. So it makes some sense if you imagine, let's imagine you have an asset and you sell a 5% out of the money call and that asset doubles in price. What's the delta of your strategy now? And the answer is 0, right? Because you're long stock and you're short a deep, deep call with a delta of 100. So your underlying asset's not doing anything. So there's a rationale to why the upside volatilities in MSTY are relatively low. However, if we go back to that regression thing that I was talking about, I'm just going to say, and I haven't modeled this out completely because I still need to. This is the thing that Scott was talking about earlier. If they're selling call spreads, what happens is you're going to travel into a low delta region when you're in that spread, but as you come out of the long side of it, now you're long the underlying, or you have some delta to the underlying, depending on how many call spreads they did versus just outright short calls versus their delta long. And you get this little tail, this little kicker, right? So actually, I would suggest that I think maybe way up here, we have to monitor their positions day to day because they're changing it. And as Scott pointed out, these are thoughtful people. They didn't set one rule set and then just said, okay, this is all we're ever going to do, whether it's a good idea or a bad idea. They're trying to be dynamic. So as volatility has come in, which means that the premiums are going to collect or going down, they're making sure that they're not selling off their upside for nothing. And I actually am wondering whether this upside, that it should have a little bit more of a smirk, but well beyond the long call strike that they're getting on the short call spreads. What do you think?
Yeah, look, I think you're right. I think that there should be a little upside tail there, given that they're putting on call spreads. So there may be some cheap options that are way out of the money.
So as you guys are looking at MSTY, and if you're thinking about trading options on it, what you need to do at any moment, and I realize, look, nothing comes free, right? So what I'm talking about right now means that, whoops, what am I doing? Going to the wrong one. What you actually have to do, everybody gets a little bit of homework now. So the homework is that if you are trying to put on an option strategy, monitor the implied volatility of MR, understand that MSTY's objective is to try to sell it, but if it gets very low, look at what MSTY's holding as I'm looking at it right now. It's going to be 24 hours old, but that's probably good enough because I don't think they're not day trading over there. It'd be hard to day trade with positions this big, by the way. And if you start seeing some long upside calls, and I overheard somebody say they had some long upside calls, here, the 480s, is that what is MicroStrategy right now?
400, 405.
Yeah, so they own the 480s. Yeah, look at this. So they own 10,000, just about, May 480 calls. They own 7,000 of the 420s. So this is what you want to keep your eye on. So you can net out the short calls against the long calls to figure out how many call spreads they're in. Then you calculate how much delta they're actually going to have on the upside relative to their asset base. And it looks like they're going to have a little bit of long delta. So their delta does trail off significantly because they are, in fact, short a lot of calls here, as you can see. This is probably not in strike order. It's not. So they're short the 417s and all the way 422.5. So they're short a lot of calls here. But they also have a little kicker on the upside. So I actually think you can monitor that. And like I said, they publish this every night. You get basically you get T+1 transparency if you're an investor, because you're not going to see this until after the end of the closing trading day, because they post it overnight. But anyway, Scotty, this has been great having you, man. I always love these conversations, and I just find them it's just informative for me and hopefully for some of the people watching. So it's really been great having you here.
Love to be here, Mike. Thank you so much for having me.
Everybody, I know that a lot of people watching already do follow DarkSide on X, but if you don't already, listen to them. And the thing is that I love about these things is that these spaces are recorded. So I walk the dog and I was listening to you and to Gary and to Michael and to Scotty, because those spaces go on for a long time. I think Michael and Scotty were talking with you for like 70, 80 minutes. Yeah. I mean, you're not getting... I don't know where else you're going to hear from people who are managing an actively managed derivative fund and actually get to pick their brains for, an hour and a half, which is just phenomenal. It's phenomenal. All right, brother. It's been great having you. And thank you, everybody, for watching. We'll see you here on Wednesday. Thanks for watching.